All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm doing.
And today we're going to kind of continue a little bit of talking about that debt crisis and debt ceiling and like the background of that whole deal. Dylan did a separate video where we talked a little bit about like what the implications could be for the stock market. I just briefly want to give the background here a little bit and like, kind of a more global picture, I guess, about the whole thing. But
if you like this kind of entertaining stock market content, we are just two stupid guys trying to figure everything out. So go ahead and give us a like and subscribe.
Yeah, that will get to it.
Two Stupid Guys Trade Stocks.
All right. So, for those of you, we kind of mentioned in the other video, but this is the U.S. National debt clock, sitting here at the $28.8 trillion in U.S. national debt. That's quite a number, made me think of what's Austin Powers, what's his name again?
You don't know his name? I'm not going to help you. It's Dr. Evil.
I've forgotten his name. But,
it's Dr. Evil.
$1 billion. Dr. Evil?
Yeah.
So this is the total U.S. national debt. This is from the St. Louis Fed. This only goes up. Basically like the S&P 500 only goes up.
Is it cool if I go to a bank and just borrow a bunch of money with no intention to pay it back?
Only if you start your own country.
Okay. That's fair.
Dylanistan. I like it.
That's pretty dope.
All right. So this is kind of the backstory here a little bit. Only Congress can authorize borrowing. That is set out by the U.S. Constitution on Section 8 or whatever the hell it was called. But basically, the right to borrow money is granted to Congress. Right. Prior to 1917, every single debt issuance by the U.S. government was voted on individually. Every bond that was issued by the United States government was voted on by Congress before 1917. 1917, they kind of changed the rules because they realized, like, the world's growing. We're in the middle of World War I here. We need to raise a bunch of money. So they started instituting a debt ceiling. It was the amount that the Treasury was allowed to borrow up to that point, with Congress's approval, rather than doing each individual bond offering there. Now, since 2013, rather than raising the debt ceiling, suspending it has become in vogue. It's been suspended 8 times by my count since then.
So once a year?
I'm sorry?
So once a year?
Basically, some of them are short. Like some of them are 2 months, and then they're extended for another 2 months. That's kind of how I counted it. But the basic premise here, right, is like neither political party wants to say like, oh, we authorized another $2 trillion in debt, right? So what they say is we just suspended the debt ceiling.
That's a smart way to get out of it.
Yeah, exactly. Because they both can't be looking to go back to their constituents and saying like, yeah, sorry, I'm the tax and spend guy, but whatever. So it was suspended, and that most recent suspension expired on July 31st, right? So what happens when the suspension expires, right? All of a sudden, the U.S. Treasury can't borrow any more money. We've hit the ceiling. We're past the ceiling, and it's now in vogue, meaning they cannot issue any more borrowings. So they go into something called extraordinary measures. All right. Extraordinary measures includes, this is basically Uncle Sam's checking account. So they're just living off their checking account to a degree. That's they were already they had put a whole bunch of money into their kind of coffers as part of the whole pandemic response, and they've been spending that down prior to the debt ceiling suspension. But now the debt ceiling suspension they're just living off this. This is like living off a credit card. Not really sustainable.
That's good.
Yeah, eventually run out of money. The other, within extraordinary measures, there are other things that they are allowed to stop kind of contributions towards the retirement accounts for the thrift savings plan for federal employees, and I forget the other one. It was like a railroad one or something like that. But it's one of those things like as if you suspended your 401k. You stop making contributions there because you need more cash coming in the door at your house.
Right.
So, we'll talk a little bit about what happened the last time there was like a real showdown over the kind of U.S. debt ceiling and that sort of stuff. Those of you who've never seen this before, this is what credit ratings look like. There's a whole bunch of combinations of letters and numbers and positive and negative signs. The gold standard, top of the heap is up here, the AAA statuses. That's what you're looking for. Break it down into investment grade, non-investment grade, or companies that are just in full-on default, or countries, I guess, could be as well.
Right.
A little less often. This is the current U.S. national debt rating. So we have this AA plus by S&P and AAA by both Moody's and Fitch. So, they're talking a little bit here about how when the last time the market was downgraded, basically, or I'm sorry, the debt rating was downgraded. This is the result of the market. It lost 5 to 7% in one day, basically across all indices.
Oh, that's a bad day.
Yeah, that's not
Okay.
good. When the U.S. government debt is downgraded in terms of its credit worthiness, that's what happens. Pretty scary. So like, why do they care about this? And this is from this bipartisan policy center. They estimated that the 2011 debt ceiling crisis resulted in $18.9 billion in higher borrowing costs over the next decade because of that diminished credit rating. So it doesn't seem like a lot going from AAA on from one agency to AA plus, but that was enough to move the needle that much.
If anyone is wondering how severe a 5 to 7% drop is, because it's really easy just to say 5 to 7%.
Yeah.
The SPY's at 440. That's like losing like 32-ish points.
Yeah.
In a day.
Yeah.
So 440 down to like 405.
Yeah.
Throwing it out there.
Yeah, that would be very, very scary. There's actually
big
like
drop.
An interesting kind of after story to this thing. I didn't put any slides in here about this, but for those of you who are not aware, like the credit rating agencies were definitely complicit in the 2008 financial crisis, and it wasn't until after this 2011 kind of downgrade of the U.S. national debt rating that the U.S. government really started to pursue them in many ways. So there was actually like a $5 billion lawsuit lodged against like S&P by like the what do you call it? I forget the name of the agency, but they definitely got a little interesting. There was some infighting thereafter.
I would have thought that would have happened immediately after the housing crisis.
Yeah. Well, I mean, there was some, but like, they accused them of being retaliatory for the credit downgrade, which is definitely an interesting. Yeah. I mean, I was like, oh, okay, this is like Tim Geithner, who was the what do you call it, secretary at that point in time. But yeah, pretty interesting stuff. So I don't know. I'm just kind of curious what your opinions were. Let us know down below.
Yeah, this is not ideal.
Exactly. All right, I'll catch you guys on the next one.
Have a good one.